In this video, we cover accounts receivable and uncollectibles, or in other words, bad debts. Sometimes customers just don't pay what they owe. Here's a typical balance sheet, and we will be focusing inside the current assets section, which contains accounts receivable, reduced by an estimate for uncollectibles, or bad debts. Here is a real-world balance sheet, prepared by Caterpillar Financial Services for 2016. Caterpillar is the world's leading manufacturer of construction and mining equipment, diesel and natural gas engines, industrial gas turbines, and diesel-electric locomotives. Like all balance sheets, total assets equal total liabilities plus shareholders, or in this case, stockholders' equity. Caterpillar is actually two entities, a manufacturer and financial services. We will focus on the financial services entity because it is in this area where Caterpillar manages its receivables, called finance receivables on the balance sheet. These receivables, which total over $26 billion for 2016, are primarily comprised of receivables created when Caterpillar sells its products to customers and then provides customer financing. They comprise 78% of the total assets of Caterpillar Financial Services, and about 1/4 of the total asset amount when adding together the assets of both Caterpillar Financial Services and Caterpillar Manufacturing. These receivables are disclosed net, which means that they have been reduced by an estimate of bad debts. And Note 3, which we examine later in the video, will tell us more about those bad debts. To understand accounts receivable, we must first understand the principles of revenue recognition, or when should revenue be recognized on the income statement. The basic answer to this question under both US GAAP and IFRS is when the service is performed or the product is delivered. At a fundamental level, when you have done your job. That's when you are supposed to book revenue on the income statement. Sometimes cash is received before the job is done, and in that case, we book a liability called unearned revenue, which is converted to a revenue when the job is completed. Sometimes cash is received at the same time the job is done, like at a grocery store, and in that case, cash and revenue are booked at the same time. And finally, sometimes, in fact quite often, cash is received after the product is delivered or the service is complete, and in these cases, an accounts receivable is created and it remains on the balance sheet until it is removed, usually when the cash is ultimately collected from the customer. So in summary, an accounts receivable is created when cash is received after the service is completed or product is delivered, or stated another way, revenue is recognized before cash is received. The receivable increases assets on the balance sheet, and the revenue increases net income on the income statement, which is close to and increases retained earnings. For what kind of companies are accounts receivable important? Managing receivables is very important to financial institutions like American Express and Bank One because their business is making loans to customers. Receivables are also important to large manufacturing companies that own their own financial subsidiaries like Ford, Caterpillar, which we described earlier, and General Electric. These companies are actually part manufacturer and part financial institution. Telecommunications companies like AT&T, Verizon, and Comcast have to pay close attention to their considerable receivables because they provide services to and then bill a wide variety of people from all walks of life. Managing these receivables is an important part of their business. And finally, retail stores that offer their own credit cards, like Dick's Sporting Goods, have to keep close track of customer credit. Interestingly, in recent years, many retail stores have moved away from offering their own credit cards, selling the activity to financial institutions that specialize in managing receivables. The major problem involved in carrying receivables on the balance sheet is simple. Sometimes customers do not pay. Some of the receivables on the balance sheet will never ever be converted to cash. For example, the $26.2 billion receivables amount on Caterpillar's balance sheet is net of $343 million of expected bad debts, which is disclosed in Note 3 in the footnotes of Caterpillar's financial statements. Here it shows that the total amount of recorded financial receivables is $26.555 billion, reduced by expected bad debts of $343 million, leading to the balance sheet amount of $26.2 billion. Certainly, companies like Caterpillar do their best to minimize this problem by creating incentives to pay quickly, sending out reminders, creating collection departments, and sometimes even hiring collection agencies. But in the end, some of the receivables just never turn into cash. In Caterpillar's estimate, over $300 million worth, a little over 1% of total receivables. To give you an idea of how big this problem is, here are some stats taken from recent financial reports of 4 major companies. Bad debts as a percent of total receivables. While these percentages may seem small, from 1.1% to 4.6%, Verizon's 2016 accounts receivables balance was $17.5 billion, meaning that its bad debts were something like $805 million. Not exactly spare change. Turning back to our generic balance sheet, when we look at the gross accounts receivable number, in this case $350, we know that it is an overstatement of the amount of cash the company can expect to collect. However, we do not know how large the bad debts will be or which specific customers will not be paying. As a result, the bad debt amount must be estimated as of the balance sheet date. And there are 2 basic methods used to create the estimate. Aging, which provides an estimate of collectible or good receivables by analyzing the receivables on the balance sheet, and percent of credit sales, which provides an estimate of uncollectible or bad receivables by focusing on credit sales, which appears as a revenue on the income statement. Let's talk for a minute first about aging of receivables. Under this method of estimating bad debts, we first review the individual receivables and categorize them on the basis of their ages. For example, let's assume that we have a total $100,000 gross amount of accounts receivable on the balance sheet. Old receivables more than 30 days outstanding and new receivables less than 30 days outstanding. $30,000 in old accounts and $70,000 in new accounts. Based on our experience, we assign a higher collectible percentage to the new ones, say 99%, and a lower collectible percentage to the old ones, say 98%. We can then estimate our collectible net balance in accounts receivable, $98,700, which becomes our estimate of the ending balance sheet amount. This means then that we have to reduce the $100,000 gross accounts receivable balance by the difference, which in this example is $1,300, and we call this difference the allowance. In essence, under aging, we estimate the collectible receivables and then compute the allowance or uncollectible receivable dollar amount. This method of estimating bad debts, the aging approach, provides close control over receivables management by focusing on the individual receivable accounts, the place where collection efforts should be directed. All companies that offer credit to customers should use this technique or something like it to keep close track of the age, condition, and collectability of their receivables. However, the next method of estimating receivables, the percent of credit sales approach, is more popular for purposes of financial statement reporting, primarily because it is much simpler, requiring much less detail. Unlike the aging method, which directly estimates the net accounts receivable amount or collectible receivables, the percent of credit sales approach directly estimates the allowance or uncollectible receivables, which is subtracted from the gross accounts receivable in the calculation of net accounts receivable. The estimate itself focuses on the credit sales of a given year, $100,000 in this example, which comes from the income statement, and simply multiplies the credit sales times a historical bad debt percentage, in this example 2.5%. In other words, of the $100,000 in credit sales recorded this year, we estimate that 2.5% or $2,500 will not be collected at the $2,500 estimate for the allowance. As indicated earlier, this method is widely used for estimating the bad debt amount used on the financial statements because it is simple, and further it represents an application of the matching principle because the bad debt expense for the year, which will result directly from the estimate, will be matched against the credit sales amount on the income statement of that same year. In the next section, we walk through an example showing how this approach is applied in practice. In this illustration, let's assume that a company called Carson Services is in its first year of operations. All of its sales are made on credit, and the typical bad debt rate in the industry runs at about 5% of credit sales. In addition, the company has a policy where it writes off receivables that have been outstanding for over 1 year and transfers these accounts to its collections department in hopes of collecting at least some of them. We will track the activity of Carson over a period of time slightly over 2 years, and during that time we will maintain a general ledger which will include T accounts for cash, accounts receivable, and allowance for bad debts, sales, and bad debt expense. As part of the general ledger, the balances in these accounts appear on the financial statements. Cash, accounts receivable, and the allowance account map directly to the balance sheet, while sales and the bad debt expense accounts map directly to the income statement. The allowance for bad debts account is a contra asset account, like accumulated depreciation, that on the balance sheet appears next to and subtracts from accounts receivable in the calculation of net accounts receivable. In this example, we also introduce a new concept called subsidiary ledgers, which provide detail for the general ledger accounts. The accounts receivable general ledger account, for example, is comprised of accounts representing individual customers. In this example, we include 4 subsidiary ledger accounts, one each for customers Jones, Taylor, and Smith, and one for all other customers. Note the addition of all the ending balances in the receivable subsidiary ledgers always equals the overall ending balance in the accounts receivable general ledger, which appears on the balance sheet. Now that we have set the stage for the example, let's get to the business activity of Carson Services during its first year of operations. During its first year, Carson recorded credit sales, all in account, of $10,000, which would give rise to this entry. In the general ledger, the entry would be posted to the accounts receivable and sales, and in the receivable subsidiary ledgers, the accounts for customers Jones, Taylor, and Smith would be increased by $100, $300, and $600 respectively, with the remaining sales, $9,000, going to the other customer accounts. Note again that the addition of the balances in the subsidiary ledger accounts equals the accounts receivable balance in the general ledger. During the year, $6,000 was received by Carson from customers on the accounts receivable sales, which in the general ledger increases the cash account and reduces the accounts receivable account. Note further in the subsidiary ledger that all $6,000 was received from customers other than Jones, Taylor, and Smith. And the final balance at the end of year 1 in accounts receivable is $4,000, made up of $100 owed by Jones, $300 owed by Taylor, $600 owed by Smith, and $3,000 owed by other customers. At this time, Carson knows that some of these receivables will not be collected. So it must prepare an end-of-period EOP bad debt estimate. At the same time, at the end of the year, Carson must also record an entry to reduce the accounts receivable balance. The estimate, which in this case is based on an industry rate, is 5% multiplied by the credit sales for the year, $10,000, leading to an estimated bad debt dollar amount of $500. The entry records bad debt expense, $500, but it does not reduce accounts receivable directly, because such a reduction would also have to be made in the subsidiary ledgers, and Carson does not know which customer accounts will turn out to be unpaid. For this reason, the contra asset account allowance for bad debts is created and credited. Because the amount in this account is subtracted from accounts receivable on the balance sheet, accounts receivable can be reduced to a net number without having to know which specific customer's accounts will go unpaid. Note too that in addition to reducing assets, this entry reduces net income and ultimately retained earnings via the bad debt expense. The bad debt entry would be posted to both the allowance for bad debts and the bad debt expense accounts in the general ledger, and no adjustment would be made to the customer accounts in the subsidiary ledger because accounts receivable is unaffected. After the books are closed at the end of year 1, Carson has these balances in the accounts. Recall that sales and bad debt expense are temporary income statement accounts that are closed to zero to begin the next year, and in this example we are unable to know what the ending balance in cash is because it would reflect all the cash transactions that occurred during the year. The year-end accounts receivable disclosure on the balance sheet would look like this, with gross accounts receivable of $4,000 being reduced by the $500 bad debt estimate in the allowance account, leading to a net amount of $3,500. We now move to year 2, and during the year Carson made $12,000 of credit sales and received cash from customers of $11,000. In the general ledger, the credit sales would increase both accounts receivable and sales, each by $12,000, and the subsidiary ledger indicates that all the sales were made to customers other than Jones, Taylor, and Smith. The general ledger would also show an $11,000 increase to cash, an $11,000 reduction to accounts receivable, and the subsidiary ledger reveals that the $11,000 of customer cash receipts were collected, $600 from Smith in full payment of the account, and $10,400 from the other customers. As of the end of year 2, therefore, the Jones and Taylor accounts are still unpaid and remain outstanding. Again, before the financial statements are prepared, as of the end of year 2, Carson must estimate bad debts, this time $12,000 times 5% equals $600. And Carson also records an adjusting entry for $600 that recognizes bad debt expense and increases the allowance account, just as it did at the end of year 1. This entry would increase bad debt expense, reducing net income in year 2, and increase the allowance account, which is subtracted from accounts receivable on year 2's balance sheet. We are not quite finished, however, because we note that Jones and Taylor accounts, which were established during year 1 and total $400, $100 plus $300, are now at the end of year 2 older than 1 year. Recall that Carson's policy is to write off accounts more than 1 year old, which means that $400 of accounts receivable must be written off with this entry, which reduces the allowance account established for this very purpose. And now, because Carson knows which accounts turn out to be uncollectible, Jones and Taylor, accounts receivable and the subsidiary ledger accounts for Jones and Taylor can be reduced. Year 2 is now complete, and these ending balances appear in the general and subsidiary ledgers: $4,600 in accounts receivable and $700 in the allowance account, with accounts receivable only comprised of accounts from customers other than Jones, Taylor, and Smith. On the balance sheet, as of the end of year 2, the net accounts receivable dollar amount would appear like this: $4,600 gross accounts receivable less the $700 allowance equals the $3,900 net accounts receivable. Carson now moves into its 3rd year of operations. And recall that because the Jones and Taylor accounts are over 1 year old, they have been turned over to the collections department. Early in year 3, Carson receives the happy news that the collections department was successful in recovering the $100 Jones account. The entry for this recovery would reflect the $100 cash receipt, and since the receivables have already been removed from the books, the allowance account, which was written down at the end of year 2, would be reinstated, reversing the write-off of an account that in the end was actually collected. The write-off entry is only recorded in the general ledger accounts, reinstating the allowance of $100, which now has an ending balance of $800 and represents estimated uncollectible accounts that are expected to be written off in the future. Let's now summarize the entries associated with accounting for bad debts. At the end of each accounting period, bad debts are estimated, leading to an adjusted journal entry that creates an expense and reduces assets via a contra asset account called allowance for bad debts or uncollectibles. When specific accounts are deemed uncollectible based on company policy, the allowance and specific accounts receivables are both reduced. And when previously written off accounts are recovered, the write-off entry is basically reversed. A review of the contra asset general ledger T account allowance for bad debts would show that the beginning and ending balances are carried on the right credit side along with accounts receivable recoveries and the year-end bad debt estimate, while the accounts receivable write-offs appear on the left debit side of the account. Let's close the video with a look at how Caterpillar discloses its receivables and bad debt information on its financial statements. Here's the assets section of Caterpillar Financial Services balance sheet, which we introduced earlier. It discloses the net amount of outstanding finance receivables as of the end of December 2016. $26.2 billion, a bit lower than the prior year's $27.4 billion. Also, as we introduced earlier, Note 3 shows us that the net dollar amount on the balance sheet, $26.2 billion, is the result of subtracting an allowance of $343 million from a gross amount for the financial receivables of $26.555 billion. Caterpillar's income statement, which discloses the revenues, expenses, and profits recorded for 2016, 2015, and 2014, shows a provision for credit losses of $135 million for 2016. This amount is what we called bad debt expense in our earlier example. It is the result of the bad debt estimate made by Caterpillar at the end of 2016. Note that it represents about 5% of total revenues. Here is the operating section of Caterpillar's statement of cash flows. It is prepared under the indirect method, which begins with the reported net income number, $390 million, and lists the adjustments necessary to reconcile the income number to the $1.4 billion net cash provided by operating activities dollar amount. Note that one of the adjustments is an add back of the provision for credit losses, $135 million, the very same amount we observed earlier on the income statement. Recall from our previous discussion that the journal entry to record this provision, or bad debt expense, did not involve a cash outflow. In Caterpillar's case, it was a debit left side to provision for credit losses and a credit right side to the allowance account. Expense reduced net income, but did not reduce cash from operating activities. Consequently, the $135 million amount is added back when reconciling Caterpillar's profit number with Caterpillar's net cash provided by operating activities number. We now turn again to Note 3 in the footnotes to Caterpillar's financial statement, where we see a description of the activity in the allowance for credit losses account. The 2016 year-end balance of $343 million corresponds to the $343 million amount we saw earlier when we first examined Note 3. This amount is subtracted from gross receivables in the calculation of net receivables, which appears on the balance sheet. It represents the dollar estimate for uncollectibles as of that date. You can see here that the beginning balance in the allowance account for 2016 was $338 million, decreased by the write-offs during the year $158 million, and increased by the recoveries $35 million, and increased also by the provision for credit losses or bad debt expense, estimated at the end of the year $133 million. In addition, there are two small adjustments due to the sale of some receivables and foreign currencies, both of which are beyond the scope of what we cover in this video. Caterpillar's allowance for credit losses bad debt T account activity, viewed in the same way we analyzed Carson in the earlier example, would look like this. A beginning balance of $338 million plus $35 million in recoveries during the year, less $158 million in write-offs during the year, plus a year-end estimate for future periods of $133 million. A small adjustment for the other items, receivables, sales, and foreign currencies, leading to an ending balance of $343 million. This description of the activity in Caterpillar's allowance account provides a complete explanation of the net finance receivables balance on Caterpillar's balance sheet.